You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
And welcome to Volatility Views. I am your co-host, Mark Sebastian. Mark Longo is on assignment at the Options Industry Council, which means you don't get to hear about all the different ways that you can download this show today. In fact, I'm going to cut right to the show. Now, normally, we would start out the show with our volatility review, but I have what I would say is a pretty awesome guest here with me. So, good, awesome, super trader, smart guy, book writer, author, Euan Sinclair is going to join me for a quick interview. And so with that, I'm going to move into my volatility viewpoint.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, and welcome to the Volatility Viewpoint. As I mentioned earlier, I'm joined by Euan Sinclair. He is the former risk manager of Bluefin Trading and author of Volatility Trading, editions 1 and 2. And I don't know if he's working on another book or not, but we'll find that out. Euan, thank you for joining us.
Well, thanks for being invited back.
It's great to have you. I can tell you that every time I mention that I'm having you on, all my friends that are really into the math of volatility and the guys that are one rung below pure academia that still actually do what they do, they actually do what we do, they get excited. They start jumping around and acting all giddy. So myself included. So why don't you give us just for if this is somebody's first time listening to the show, why don't you give us the 30-second rundown on who Euan Sinclair is?
Okay, I did a PhD in theoretical physics, and that was a long time ago now. That was 1995. Then I spent probably 7 or 8 years as an option trader, market maker on Eurex, making markets and index options. And since then, I spent a lot of time doing sort of quant analysis and risk management for a couple of firms, most recently Bluefin Trading, and I left them at the end of last year, and I'm setting up a couple of operations on my own right now.
Well, that's great. So first question, and this is a question we ask a lot of guys, is, we've seen a huge drop in VIX options volume. All right, pretty huge, 45%. All right. At the same time, the futures are really not seeing the same type of drop off. What do you think is the big driver behind the drop in VIX option trading?
You know, a lot of people have asked me that as well, and I think I don't have anything other than just unsubstantiated wild guesses, which I don't think really add to the conversation at all. I mean, I don't know. It's a weird question, right? Because you would think one sort of drives the other. It's not obvious right now what scenarios people would actually be using VIX options to hedge. The markets are quiet. They've been quiet for a long time. Oil's come off a lot. There don't seem to be any repercussions from the latest Iran deal or Ukraine. So the geopolitics is very quiet. But having said that, you would think that the volume in VIX futures and the volume in VIX options would sort of go the same way, and that really hasn't been the case. So I don't know.
So, is the issue just that traders that want to hedge are just going straight into the futures? Part of me thinks, I know that we've seen some big, my question is a lot of the drop off, you think, from the hedging side, or is it from the, is the big drop off from the guys trying to play premium selling in VIX and the contango play?
Well, I think that's still going on. I mean, that's been very successful. I think probably what you've got is the VIX futures volume has a sort of underlying floor to it now because of all the VIX ETNs that are listed, which invest in VIX futures. And I think the VIX options doesn't really have that. So I don't see any institutional demand for VIX options. Mm-hmm. I think you can make an argument, and I wouldn't make an argument at the strenuous level that the CBOE does, but you can make an argument that VIX futures are somewhat hedging for equity portfolios. But VIX options are, they're not really, it's sort of more of a speculative play. And right now, I'm not really sure what it is I would speculate on. See, for example, we know that VXX has this decay to it. Well, I mean, the VXX has a term structure caused decay. VXX has sort of made a fairly calm drop from about 37 to about, where is it now, like 21?
No, 21, yeah.
So that's telling you the term structure is still very steep, because VIX has really been stuck in this range from like 12.5 to 15. VIX isn't going to go a lot lower, so I'm not sure why anyone would be particularly interested in speculating with puts. And I don't really see anything on the upside for VIX. I mean, it can always go up. I mean, there could be something horrible happen tomorrow, but there's nothing sort of scaring the markets right now.
Yeah.
So I'm not sure I'd really want to be going out and buying VIX calls either. So there's no intrinsic hedging driving the VIX options. And I don't really think anyone's got anything to sort of speculate on right now. We're heading into summer, and things are pretty quiet.
Yeah, things have been super quiet, actually. From a macro perspective, where do you see potential volatility worldwide? I mean, could the V stocks pick up? Could we see some area of volatility? I like to say we've had multiple 2011 type events in the last year in non-equity markets. We've seen gold have a 2011 type event, currency, and oil. Where else could you see, the net volatility in the near future?
It's difficult to say, to be honest, and that's why I think that I'm not the only one who's missing this. I think we've got a Fed now that is much, following on from Bernanke, much clearer about what they're intending to do. They don't give surprises. You may disagree with some of the things they're going to do. I mean, traders always disagree, and they generally disagree based on absolutely no education or real ability to predict, but whatever. But they're much more open than in the Greenspan years. Oil dropping is good for the economy in general, so that sort of removes something bad. All I can see really is the world has sort of calmed down. Ukraine is sort of, everyone's forgotten about it. Iran is sort of, I think, happy with the political solution they appear to have reached. I think the people who are most unhappy with that are congressional Republicans. Mm-hmm. And that's the other thing. Politically, we're in kind of a holding pattern. I don't really think the Republicans are going to cause the sort of issues they have in the past, because we're coming up to an election, and I think they will they'll realize, I mean, that just hurt them last time. So I think they're going to sort of stay quiet. I mean, honestly, I don't see, apart from like the genuine out-of-the-blue events, you know, tsunami, asteroid strike, something like that, I just don't really see anything.
What about bond vol? You know, I don't know how into interest rates you are, but you know, when I look around, the area where I think there is potential for a blow up would be potentially in, you know, we saw a tiny mini version of that this week, right? Would be a breakdown in liquidity in the interest rate market. I mean, you know, the VXTYN, which is the VIX of the 10-year, is still under 6%. But, you know, do you think, I mean, is there a scenario where the bond market could move from a yield of, you know, 2.15 right now to 3% pretty quickly and really send the world into turmoil? I mean, I don't know. What are your thoughts on that environment?
Okay, look, back a little bit there, Rick Santelli. 2.15% to 3% is not going to be cause for turmoil. That might be cause for a few bond traders to get upset, but you know, the world really is, if you're dividing the world into high interest rate environments and low interest rate environments, I wouldn't be too concerned on a macro scale unless, you know, US bonds started yielding over 5%. I've said for a long time, not to you guys, but to sort of some of the long-term investors I know, that I think bonds are inherently very risky at these levels. There's a lot of downside and not much upside. So I've been telling them to either stay in cash or very, very short duration bonds, you know, the 1 year type things. But I don't really see anything on the horizon that throw up bond volatility. I just think that there's very little upside in them. I mean, there's no way I'd invest in US bonds yielding these levels, you know, at the 30-year level or something. In fact, I think the US should be issuing more. I mean, it's almost free money to them.
Yeah.
But no, I just think the interest rate traders I know have been sort of saying, well, you've got to be long at these levels. You've got to be long at these levels, and they've been paying theta on these options for years. I mean, I don't see really why at these levels you have to be long at all. You may not want to play, but I don't see the edge in being long vol at 6% or whatever it is in the 10 years. It could stay there for a long time.
Yeah, we could stay here for a long time. It's interesting. Yeah, you know, the trade I wonder why nobody does is, you know, you sell U.S. Treasuries, take the cash, and collar an S&P portfolio and collect the dividend. I mean, that just seems like kind of a no-brainer, right?
It's sort of it's a carry trade, right?
Yeah, it is a carry trade, yes.
Carry trades always look good until they blow up.
Yes.
Yeah, I agree. It looks, you know, theoretically nice. I can't see anything specifically wrong with it. It's just, for example, I've seen some of these things right now where people are being encouraged to, you know, remortgage your house and invest in equities, which is largely the same thing. It's just going through a mortgage company instead of the U.S. government.
Yes.
And you're like, well, okay, so you get tax benefits for doing that. You could quite easily lose on both ends. If we see a 2008 scenario again, your house is going to lose a ton of value. You're going to be massively in the hole on your mortgage, and your S&P that you've just bought is going to be 20% lower.
So, well, maybe that's where you could use VIX as your hedge, your VIX options.
And this trade is now getting more and more complicated.
Yes, it is. It's turned from a simple carry trade to a carry trade plus long vol. You know, I was at. Did you go to a risk management conference in March?
This March, the CBOE one? No, yeah. I didn't go this year.
Yeah, you know, they did. They had this guy that talks about the monumental blowups of the last 30 years, and they all almost unilaterally involve a carry trade. And
I'm a huge fan of carry trades, actually. I don't want to sort of put them down. It really comes down to how you manage the exposure and how you manage the risk. Like all of these trades that make good, consistent money, I mean, value investing, for example, is just a carry trade. But there are risks involved. And so when the carry is giving you the money, don't focus on making money. In that case, focus on protecting it. And I think a lot of people just sort of get overconfident. And then if you leverage a carry trade, you're really asking for trouble.
And that's what's really blown up a lot of people. MF Global most recently. They're all involved in carry trades that eventually win, and they all blow up from over-levering. And it's amazing how that pattern consistently repeats itself.
Yeah. Whereas like Warren Buffett, for example, and I'm going to include him as a carry investor because value investing is actually a carry trade. He's just been very good at that. He's been, I'm going to make 17 to 20% a year. That'll do really nicely over 50 years. Whereas it seems like the trader's mentality is like, well, if I can make 17%, why don't I just leverage it and make 50%?
Right. So, and it's led to a lot of people blowing up. So let's just finish with I don't know if you saw that CBOE's launching VIX weekly options. Do you think that those are going to succeed where kind of VXST has been kind of a mess?
Well, given that right now, we've already discussed, no volatility options are doing particularly well. So it's not coming into a booming environment. But actually, I'm relatively bullish on this. VXX weekly options have done well.
Yes.
I don't see why VIX weekly options wouldn't do well. The problem with VXST wasn't the short duration of any options on it. It was the actual index itself was just kind of random. It was just kind of noise. There were no useful relationships you could get between that and the equities or that and VIX or that and VXV. It was just, I looked at it. I was kind of excited. I was like, this might throw up a lot of opportunities, and there really just wasn't anything there. It's like betting on coin tosses or something.
Well, I've always argued that the main reason why all the other volatility products have failed is that there was no related upstairs desk trade to that listed product. I mean, I think that's always been my argument for VIX being successful is that VIX was already trading just over the counter and at wider margins.
Yeah, that probably has something to do with it. But I think one of the reasons that was trading as well is because it had certain hedging abilities. It's had certain sort of – you need to have a certain degree of predictability or at least consistent behavior. Whereas VXST, I think there's a reason that no one ever listed OTC variance swaps on like a weekly basis. I don't think there was any demand for that either. It's just – it's just noise.
I always thought the argument for VXST was I was going to be able to hedge, like going to non-farms today. If I bought a straddle and sold and hedged the Vega and VXST, I could really isolate gamma to do more what I want. But I think that's such a small market that it wasn't able to work. Like, I happen to know if you look at the open interest on VXST right now, it's 136 contracts, and I specifically know the person that is long that 100 of those contracts, and it's just hilarious. There's just nothing in it, and so now.
Yeah, if you're going to list a contract because you think traders will like it, you should probably think again.
That's exactly right.
Traders aren't the tail on the dog. They're not even the wing on the flea. We are right at the bottom of this ecosystem. What we want really doesn't and shouldn't matter. We have to kind of adapt to the way the world is, not try and shape it to what we want.
Oh, that's a brilliant line. I love that. All right, now, lastly, and I'll let you go then, is you recently authored a paper titled "Alternative Risk Measures and Stock Selection." Why don't you give us a little bit about what it's about?
Yeah, thanks for mentioning that. I think it is of relevance to this audience. When we talk about volatility as traders or investors, I'm going to include everyone here who is involved in the markets, what we really mean is how much is something wiggling around. Whereas when an academic talks about volatility, what they're talking about is the standard deviation of returns. And that is a measure of variability or volatility, but it doesn't have to be the only one. So I think most of the studies that have, for example, shown that low volatility stocks outperform high volatility stocks are based on this very specific measure of volatility, the standard deviation one. And I just wanted to see if it was a more general thing than that. And it turns out it is. You can use other alternative measures of stock variability. And for example, I used entropy and the Hurst exponent, which both measure variability but in slightly different ways, and found similar effects. Now, not exactly the same effect, which is interesting. I don't know why, but the standard definition of volatility slightly better predicts this outperformance than these other ones. And that's a little weird because I'm pretty sure the market itself doesn't understand the mathematics. So I'm not really sure what that volatility captures that other measures of variability don't. That may be a work in progress, or it may just be something that dies on the vine at this point.
Fascinating. Absolutely fascinating. Well, Euan, I'm not going to tie up more of your time. I know you've got options expiration, but if people want to get this paper or find out more about you, what should they do?
The easiest way right now for that paper is to go to ssrn.com, which is the Social Science Research Network. And if you type in search and then search under my name or search under entropy, the paper will turn up fairly quickly. It was published on there about 3 months ago, so it should be relatively easy to find.
Well, I really appreciate you being here, and hope you have a good day and you have a great day trading.
Well, thanks very much, and have a good weekend.
All right, you too, Euan. All right, and with that, now that we've heard that great stuff from Euan, let's move out of the volatility viewpoint and into the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
Well, boy, what a week. We saw the VIX Cash have a pretty decent range. We saw it as low as 1210 on Monday, as high as 1636 on Wednesday. And here we are, and it's back below 13 again right now. Just a crazy week with non-farms. VXST, even bigger range as I'm discussing this now. VXST is down to below 12, so a major move in that. Major VIX option trades, we saw lots of buying on the May 20s and the May 19s. Lots of call buying, decent volume. We saw somebody buy 35,000 of the May 19s, another 35,000 of the May 20s, both buy. Makes sense. Those have been big levels. There was a big buyer today of the 1621 call spread. So despite the fact that VIX keeps falling, we have people buying these upside calls. That's the hedging portion of the VIX options. Big open interest levels. The June 23 calls are the biggest open interest right now. So kind of surprising, but that is a little bit of a random strike to be the biggest open interest. The next biggest is, and that's almost 400,000 cars. The next biggest, much less surprising, the May 20 calls, about 360,000. The May 21's another 240,000. And the June 17's, a little less random as well, and that's 240,000. And, as I think about it, that 1723, that open interest is probably related to that big 1x2 back spread that paper did a while back. And then the rest are all in the high ones, and they're all May and June at the usual suspects, the 17s, the 16s, and the 20s, 18s and 19s. So total open interest is about 6.62 million. Calls outpacing about 3 to 1. So still lots there. But, just from a volatility component, the most volatile day of the week is today. It's Friday, and we're up $25. The market is right below its all-time high. Now, there's a lot of people that say maybe we're going to push higher into the close. It would not shock me. We're filming this about an hour and a half before things end. Kind of the laggard of them has been the RVX, which is still moving around, but is not. But the Russell of all the indexes was kind of the least volatile. Now that said, nice spread between the Russell and the VIX. The Russell RVX spread is about 17.5. Not a low open interest, but the vol itself has been nice and juicy. Other areas where vol has stayed high has been at like OIV, where oil vol has flatlined to about 36. Now, if you look at oil vol, that is a screaming sale long term, and I am a believer that is I'm a Justin believer that oil vol is going to be below 30 by July, but you still have to dealing with the actual movement. Then the final, that's kind of the interesting piece. Bond vol. So, that's where things have been – that's where I feel like things have been kind of interesting, is that, VXTYN has been around 6%. We're starting to see some movement in that name. I think we saw it get some real life to it. It got to 5.9, and the week's range, it did break 6 for the first time in a while. So that's just something to be aware of. Will that ever trade? No, but it's another thing where I do think that it's worth noting that bond vol is at least starting to move a little bit. Now let's talk UVXY and VXX. UVXY, so here's where you can really see the difference between UVXY and VXX. So UVXY today touched a low of 950, and that was the lowest it had been in terms of a touch. All right. Oh, excuse me. It got as low as 948 last week. So last week on the 4th, or earlier in the week on the 4th, with the VIX a full point lower as I'm speaking, UVXY touched the same exact level touch today. That's that daily rebalancing that really kills it. VXX is still a few points above its low. The all-time low it touched on Monday was 2048. It touched a low of 20.5 today. So kind of similar thing. Both of those, they just do, the VIX goes up and down, and they both lose money, and that's that contango. And contango as a percent is looking somewhat steep. Right now, the May future, weekend adjusted is trading at call it a 60 to 70 point premium with about 8 days to go. That's about normal. June is below 16, so relatively low with a few months to go. So that's something to think about. Now, other pieces with the S&P. I don't have Mark or anybody to disagree with me, but I think the SPOOs are going to get into an all-time high, if not today, then Monday, and close above 2120. And then we could see this. I think this is our last gasp at a VIX below 12. And then even though rates aren't going to go anywhere in June, we will see rates start to move. All right, and with that, let's get out of the volatility review and get into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
And welcome. This is where you help me co-host so that I'm not just talking by myself. And here's a question from Mark Brant. It says, please address how IV chain structure, sometimes called term structure, can make a spread more viable or less viable, and how liquidity affects such IV structures. Well, you know, certainly in some of the contract months, you can see, let's start with liquidity. Liquidity can make term structure look better than it is or worse than it is. And that's really where liquidity affects things. So you can think, oh, I've got a great looking calendar spread on or something along those lines. And then if you look and there's zero open interest on the upside, you know, there's zero open interest or zero trading in one of the months, then that volatility may just be fake. And that's really the issue, is if you've got kind of a volatility that's based on no volume, it's just a guess. And you're going to go in and try and execute a trade on what you think is a favorable term structure, and nothing will happen. And that's always an issue. Now, let's talk about how term structure can make a trade better. Hey, you know, when I've got low VIX, typically what you'll see is term structure where front month is trading at a steep discount to back month because traders are thinking volatility is going to increase. And, you know, when term structure is overly steep, what ends up happening is you think you're getting this decay from a calendar spread or something like that, and yet that calendar spread doesn't really produce anything. And when that calendar spread doesn't produce anything, that's because really the volatility was probably oversold in that month. So I like to make sure that the spread between one term and another is not too low. It's not too wide. Now, on the other end, if I can get low IV in a positive term structure, so I'm selling a higher vol than I'm buying, I'm going to want to do that trade a lot. And those are the types of calendar spreads that I really love to trade, and I feel like can really help me be an effective trader. In fact, that's kind of one of the huge setups I look for in calendar spreads, and that's because anytime I can buy volatility and get a vol credit, I'm a happy camper. That is the most reasonable. You know, I think that sets things up. Now, the question you need to ask yourself is, why is term structure that way? Now, if you're getting a vol credit and earnings are that in that term, well, then you're not really getting a vol credit. You're getting a volatility plus earnings. But if there's nothing going on, no major reason, and you're getting a vol credit, that's generally setting up a somewhat favorable trade. All right, now, next question, and thank you for the question, Mark. And now, next question is from Adam Vega. And his question is, hello, big fan. Of course you are. It's me. Thank you for the great shows. You're welcome. All right, I'm really happy that I can be here to make sure that those shows are great. It's so difficult picking up the slack for one Mark S. Longo. And then I'm currently using Thinkorswim for backtesting, but it is slow and not reliable. Any suggestions? Thank you, Adam Vega. There are a few ones out there. There's a new one out there called Quanti Carlo that does backtesting, and you run it through like I believe a Monte Carlo system. I've been wanting to test that. There's a program called TradeWinds, and it does specific types of backtesting. LiveVol has backtesting for certain types of covered calls, different things like that, and you can get historical data from them. If you're looking to go push, one button at a time, you can get backtested data. You can backtest data in something like OptionView, but that is also slow and unreliable. You can also get it from Options Oracle, which will have some backtesting. And then the other people that do it is iVolatility, I believe, has some backtesting. So there's all sorts of people out there, but it's just very difficult to find a super consistent, easy back tester for all strategies, and that's one of the big issues. So I would invite you to kind of check those ones out. I'm not an expert and I'm not endorsing any of them, but certainly give a look at Quanti Carlo and at TradeWinds, especially if you're just testing simple strategies. If you're doing really complex stuff, you may be better off just building something to optimize whatever else you're doing, and going out and buying the data. It may be cheaper to do it that way. And thank you for those great voicemails. And with that, let's roll out of my volatility voicemail and into my volatility crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
And you may have already heard me let the cat out of the bag, but I'm telling you, I think the next couple of weeks are our last gasp at 12 VIX and maybe an 11 VIX. We could see futures settle at their lowest level of the year in May. Before I think things really do potentially take off. You've got Greece. I think the Fed stuff is going to start causing some problems after May expiration. But I'm predicting an all-time high in the S&P 500, and I think that's what we're going to see. And now, as for what's going on in that option pit, on Fridays on my blog, I've started posting a simple option trade idea that I'm doing. And you can check that out. Just go to optionpit.com/blog. I should, when this show goes out on Monday, we should have posted our next webinar. It's going to be on creating income with options, and it's going to be May 20th at 7 p.m. We'll make sure to get a link in the show notes when if you come and check things out. And aside from that, come and check our stuff out. We do a lot of great stuff at Option Pit. Shoot me an email if you'd like to give things a try. And I hope everybody has a great day. And I will hopefully not be by myself next week. But until then, you enjoy this volatility trading. And I'll see you next time with Mark Longo, my partner in crime, here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.